Hello, everyone, and welcome back, Diana, to Simplifying Investing.
Hey, mate, it's been a hot minute.
It's been very hot lately. Obviously, everyone cares about the war at the moment, but I think in Australia, we do have a barrage of problems coming at us in the next coming months and quarters as well. So I have one trick question for you today. What's Australia inflation?
I can give you, I think, about 4 different numbers about the rate of inflation, because if we just take a bit of a history lesson here, historically, Australia has always had a quarterly inflation print. And then a few years ago, the ABS decided to put more money into establishing a monthly inflation indicator to be like the rest of the world, which has a monthly print. And so now we have a monthly inflation indicator where they were surveying about 2/3 of CPI items every single month. But obviously it wasn't the full indicator, because for a full indicator, you really need to be surveying everything every single month.
Almost everything.
Almost everything. I mean, some things like education don't move every month, but to try and get as much data as you can from those indicators. And then, so that started, what, about 2 years ago?
Oh, actually almost 4. So it started in 2022.
Okay. The last few years have just been a bit of a blur, I guess. And then more recently than that, they have moved to what I call a new monthly CPI indicator, where we are now surveying every single item every month. So it is more of a complete indicator, but of course we don't have the same history as we had for the quarterly one, which we have going back to the 90s, because we didn't survey everything back then. So we got the March inflation data today as we're recording the podcast, and we are focusing on the monthly headline indicator and the quarterly trim mean. So I'll tell you your trick question. What is the rate of inflation? I would say that the rate of inflation is 4.6% year on year on the headline, and the trim mean is 3.5%.
I think which numbers works better for us really depends on who you're asking. If you're asking an economist at the moment, then they would say, we should focus on the trimmed mean number at that 3.5% number over the year, because it strips out all the noise in inflation data, because inflation tends to move up and down all the time. Same with, say, airfares, for example. It literally depends on the day or the hour of the day that you look at. So if you keep looking at the noisy numbers, it's kind of hard to get the trend of where things are going.
Yeah.
So economists, as well as the RBA, focuses on that 3.5% numbers. And I guess the bottom line is 3.5 is too far from 2.5, which is the RBA target. But then there's another story to it, which is from the consumer perspective. The consumers experience the headline CPI because they have to spend on fuel. They have to spend on everything. And on that measure, it seems like the consumers are doing it pretty tough with the CPI at 4.6%.
So 4.6% inflation is obviously really high, the highest that Australia has had since 2023, so 2.5 years. But if we didn't have that impact from high oil prices, both petrol and diesel in the month of March, then it would have been more like 3.4%. But that's still, of course, too high. So petrol has added, about 1.1 percentage points to March inflation, which of course people are feeling at the moment. And the risk is that continues in the next few months. But we already had an inflation problem before the war in the Middle East started, right?
Yeah, that is correct. I know a lot of people say that we should blame Donald Trump for that, 1.1% added to our inflation. But as we said, before that inflation was already 3.4, 3.5%. And it was actually quite widespread across a lot of the goods and services in Australia. The hottest one is obviously housing inflation. So that includes rent as well as the cost to build new homes in Australia. That's been a structural issue because we have a shortage of homes, we have a shortage of tradies as well as building materials. So that has been a hot minute, basically. But if you look at medical prices, education prices, dining out, traveling, everything has been picking up since the second half of last year. So even without this Donald Trump and the war in Iran problem, the RBA was right to have hiked rates the past 2 months and probably still has a few more to go, to be honest. So now that we have that complicated problems, do you think that we're definitely going to see 2 more rate hikes in Australia?
Well, the market's priced in for about another 2 hikes from the RBA, which would basically take the cash rate to 4.6%. actually the market pricing is a little bit higher than that as well. When we talk about market pricing, it's basically what traders are assigning to the probability of bond yields going up in the months when the Reserve Bank is meeting. Based on the March inflation data, I think the RBA, well, one, they would be happy that actually the trim mean rose by 0.8% over the quarter. They had been forecasting 0.9%. And while that looks like a nothing burger, it looks like it's the same as the RBA forecast. For a number like the trim mean, it's actually quite not significant, but it's noticeable.
That was momentum basically before the war.
That's right. Yeah, because we had September quarter trim mean of 1%, then we had 0.9%, and then we had 0.8%, which shows good progress in terms of getting trim mean inflation down. However, the June quarter figure is going to be, we think, a bit higher, rising by 1% over the quarter. Part of that is related to the flow on from oil, but other areas as well. And more importantly, the annual rate of trim mean inflation in the June quarter is going to be more like 3.8%, which is even further away than the 2.5% the RBA is targeting. So I think it's going to make the RBA nervous that the outlook for trim mean and for inflation more broadly is still too high. There's still too many upward pressures on prices. So I think that they're going to hike again in May, but I do think that the board decision is going to be split again, given that the board decision was split last time they hiked in March. And looking ahead from that, I think it is possible that we get another hike, maybe in August, if we don't see oil prices stabilizing and if we don't see some better news around rents and construction costs. But it's probably not a done deal. In any case, it's hard to see rate cuts this year. I would be expecting another 1 or 2 hikes from here, but also at the same time, seeing interest rates above 5%, I don't think that that's likely.
I think a lot of the outlook for inflation, the RBA definitely doesn't know when the Hormuz Strait would be open. So a lot will still hinge on how the war in Iran is going. So since the last time we talked, it doesn't seem like a lot of things have actually changed. One thing I think that's changed a little bit over the last month is that Donald Trump clearly showed a willingness to tackle. And if you're a regular listener to Simplifying Investing, you would know that tackle means Trump always chickens out, which refers to the fact that Trump, when he sees some outward negative reaction from financial markets or from the voter base, he tends to pull back from his previous outrageous threats. And this time it is the fact that he has backed down on the threats to obliterate Iran population and directly hit Iran energy facilities. So he seems to show willingness to maybe negotiate a ceasefire. But the issue is that the Hormuz Strait is still not opened. And I think that is still the biggest question at the moment for, all economists as well as for the inflation outlook for the RBA, whether we have an August rate hike even. And right now, the Hormuz Strait is seeing around 5 to 10% of flows in terms of transit ships compared to pre-war. So we're still losing around 10 to 15% of global oil supplies. So it does seem like at least in this quarter, oil prices are still going to remain quite high, around $100 per barrel.
And that's going to have more impacts to other parts of the economy rather than just direct petrol prices, the flow through of transportation costs into basically all industries, the use of oil and its byproducts in agriculture, in manufacturing, in textiles. I was surprised actually how many byproducts oil has. And now you can see even service companies asking for some form of fuel surcharge just because they have to pay more for petrol themselves. So these flow-on effects are going to hit inflation over coming months.
I guess one thing I'm quite worried about is that it seems like it will take quite a while for these to play out in the inflation numbers as well. Because we've seen some reports of farmers in Australia. So Australia imports all of our urea fertilizer needs. We don't actually have any here in Australia. So I've seen reports that farmers are delaying putting crops for this season. And it seems like, so it's going to take quite a few months or even a year for us to actually see higher food prices.
Yeah, even if the Strait of Hormuz opens tomorrow and we get back to 100% oil flows, which seems very unlikely, it will still take time for the normalization of oil prices to pass through and for people to get confidence that this is not going to happen again next week. We really need to see the strait opening in coming weeks. Otherwise, it's going to become quite problematic for the world. But when I was looking at the inflation data today and trying to analyse it, I was thinking, is there anything that the government could do to help with the inflation problem? A lot of the areas that are the biggest contributors to inflation in Australia are services, and a lot of them are related to areas that the RBA has no control over: tobacco, medical and hospital charges, childcare, rents. I'd say that that's mixed. But we know that administered and indexed prices, which have a lot of government influence, have still very high rates of inflation above market services, above market goods, although they are plateauing, which is good news. But given that we're coming up to Economist Christmas budget season, we get the federal budget coming out on the second Tuesday of May. Is there something that the government can do to help with the current inflation problem?
I mean, they've already started doing something. Last month, they announced that they would cut down the fuel excise, so on petrol and diesel, by 25 cents per litre. So we have seen a bit of a decline in the April prices for fuel prices at the pump. So that might actually detract from headline inflation a little bit this month. They are also cutting the heavy vehicle registration, which basically targets truckies and trucks who transport, essential goods. So that part is actually might be a good thing because, they are using diesel mostly. Diesel prices have gone up a lot higher than other types of fuel. And that might actually have a pretty good positive flow-on effect on other essential goods. So that's the first thing that they've started trying to do. But I think coming up to the federal budget.
Can I just add before you go to the federal budget, that policy of cutting the fuel excise, though, may have unintended consequences. I mean, the whole point of doing that was to help consumers at a time of need. However, the whole point of the RBA hiking rates is to slow down growth and to slow down consumption growth to get inflation down. So the fact that the government's giving people more money back basically into their wallets every week by cutting the fuel excise, it sort of goes counter to what the RBA is trying to do. And it's also adding to fuel demand at a time that we're trying to cut fuel demand to to preserve our rations basically of fuel. I understand why they're trying to do it. It's optics, but it's actually quite costly for the government to do. But anyways, I'm just saying that there could be an unintended consequence of that policy.
Yeah.
Would it be better for the government to do other things, although it is harder for the government to control short-term inflation?
I mean, I do agree with you. I think part of it is right. For example, the relief charge for heavy vehicles, because I think that would have a flow-on effects to other things. But I think a widespread fuel excise cut is not a great idea at a time when you want people to switch to EVs or you want people to switch to public transports, for example. And a lot of state governments have actually made public transport free. It's not going to have an effect on headline inflation because it's such a small part of our spending basket. But I guess it's a good optics as well for the government. And I don't think it's wrong to encourage people to use public transport when we want to limit it a bit further. So I guess, I was trying to talk about the federal budget. So I hope that for the same reasons that you said, they don't actually extend this widespread fuel excise cut further. Maybe, yes, there's a need to deliver some reliefs to households when they have been hit by a double whammy of rate hikes and fuel hikes that might act as a tax on budgets. But there's a reason why the RBA does that. And the RBA wants to slow down discretionary inflation, which are all the fun travels that people have been splurging on over the last few months. And we probably need to see the government showing some restraint in these kind of handouts. And this also comes at a time when government spending as a share of the economy is still hovering around a record high, around 28% of our economy, which is much, much higher than, say, the pre-COVID average of around 25%. So it takes a lot of money. It takes a lot of cuts, basically, to go back to that level. Economists like us to go back to that 25% level because it doesn't crowd out private investments, for example. It doesn't add to pressures in certain industries like hiring tradies, for example. We don't really want the government to go out and build more infrastructure projects when we already have a shortage of homes in Australia. So that's purely a hope, though. over the last few months, we've seen a bit of leaks from the governments. It seems like they want to touch a bit on tax reform this time. Things like widening back some concessions to capital gain tax or negative gearing. What do you think about these? Do you think that it would actually solve our housing problems?
I don't think that those changes in themselves will solve the housing problem. They may help to prevent home price growth from continuing to be unsustainable over the long term. But the biggest issue is that we need to be building more homes that would actually have a better longer term impact on housing supply in the country and help with the problem of affordability. But for me, the biggest hope that I have for the budget is that the government will show some restraint in terms of spending, and that the projections for government spending are going to look more moderate than where they have been. The government's been lucky in the last few years that the budget's been in surplus basically from good luck rather than good fiscal management. Sorry, Jim. Because we've had a strong economy, high commodity prices, good business profits that has been flowing back into revenue. But they need to address the revenue base as well, because longer term, the pressures on the government of an ageing population, more spending on healthcare, aged care, childcare, and interest expense now because bond yields have risen. Those are significant pressures for the government. It was good to see a new policy around trying to reduce growth in the NDIS. I think that is the right way to go in addressing some of these ballooning programs that the government has. But to help get inflation down, the government needs to focus on reducing its share of GDP. As you said, it's currently at a record high, and reducing its share of the economy. I think that would actually be the biggest help that the government can have in the current environment. But we will wait and see what the budget holds for us in 2 weeks' time. And of course, markets always sort of worry about the budget. The market impact for the budget is actually pretty minimal. But the longer term impacts to the economy can actually be quite significant if those policies then get through the House and the Senate.
Agree. So we'll come back with our analysis of the federal budget in 2 weeks. So stay tuned for that. In the meantime, if you want to entertain yourself, I would suggest looking at the number of ships transiting through the Strait of Hormuz, because to be honest, that's the one single number that matters the most for the global economy at the moment.
Thanks, Mee. See you next time.
Thanks, Diana.